Welcome to Market Brain, where we dissect the intricate machinery of financial markets. Today, we're plunging into the heart of market volatility, specifically how sudden, dramatic price movements, what we call jumps, fundamentally alter the landscape of options pricing in the infamous VIX index. You see, traditional models often assume smooth, continuous price changes. But the real world, as we've seen countless times, can be anything but smooth. We're talking about those moments when the market seems to lurch, not glide, and how that impacts our understanding of risk, especially for options nearing expiry. First, let's demystify the VIX. Often dubbed the market's fear gauge, the VIX isn't just a random number, it's a forward-looking measure of the market's expectation of volatility over the next 30 days. Crucially, it's calculated directly from the prices of a wide range of S&P 500 index options. Think of it as a weighted average of implied volatilities for these options. A high VIX suggests investors anticipate large price swings, while a low VIX implies relative calm. But what if those anticipated swings aren't smooth, but sudden, discontinuous leaps? Most introductory financial models describe asset prices evolving smoothly, like a gentle stroll. This is often represented by a stochastic differential equation where price changes are driven by a drift term, $/mus_TDT$, and a continuous random component, $/sigma S_TDW_T$, representing normal market fluctuations. However, real markets experience jumps, sudden, significant price changes that happen discontinuously. These are represented by the $DJ_T$ term. Imagine a stock price not just wiggling up and down, but suddenly dropping 10% in an instant due to unexpected news. This jump component is precisely what traditional models often struggle to capture accurately. Now, let's talk about short maturity options, those contracts with very little time left until expiration. These options are like hypersensitive instruments, magnifying the impact of any immediate market event. Their value decays incredibly fast, and their prices become extremely responsive to even tiny changes in the underlying asset or perceived volatility. This makes them particularly challenging to price accurately, especially when the possibility of a market jump looms. And remember, these short maturity options are the very building blocks from which the VIX index is constructed. This brings us to the core of the research, short maturity asymptotics. When we say asymptotics, we're essentially looking for powerful approximations. Imagine you have a complex function describing an options price, $F(t), where $T$ is the time to maturity. As $T$ approaches zero, the function can be approximated by a simpler series, like $AT*(alpha plus BT*(beta$. This isn't just a guess, it's a mathematically rigorous way to find the dominant terms that dictate the option's behavior when it's about to expire. This allows quants to derive closed-form, highly accurate formulas for option prices and the VIX in these critical, short-term scenarios, even with jumps. The paper tackles this by combining local stochastic volatility models with compound Poisson jumps. Let's break that down. Stochastic volatility means volatility isn't constant, it's a random variable that changes over time. Local volatility means it also depends on the current asset price. Now, add compound Poisson jumps. This means jumps occur randomly, like a Poisson process, and the size of each jump is also random. This sophisticated framework allows for a much more realistic representation of market dynamics, capturing both the gradual evolution of volatility and those sudden, unpredictable market shocks. So, how do these jumps specifically impact the VIX? When jumps are present, they significantly alter the implied volatility smile, the pattern of implied volatilities across different strike prices for options with the same maturity. For short maturity options, this distortion becomes particularly pronounced. The research shows that the leading order asymptotics for VIX and option prices are directly influenced by the parameters of these jump processes. This means that on a day where the VIX is particularly volatile, understanding these jump dynamics is crucial for accurately interpreting and forecasting near-term market expectations and potential extreme events. This cutting-edge research provides quants and traders with a powerful new lens to view short-term market dynamics. By offering closed-form asymptotic formulas, it allows for more precise pricing of European options and a deeper understanding of the VIX index, especially in the face of sudden, discontinuous market movements. In a world where microseconds matter and unexpected events are a constant threat, having models that accurately account for market jumps isn't just an academic exercise, it's a critical edge for navigating and profiting from the inherent volatility of financial markets. Stay sharp, stay curious, and we'll see you next time on Market Brain.